With so much talk about inflation creeping around the corner, my next guest has a different point of view. He is Puru Saxena. He is a retired investment manager, now managing his own money. As he says, he used to take care of other people's money. Now he's just taking care of himself. He joins me from Hong Kong. Puru, it's been a really long time, almost a decade. So nice to be back with you.
Yes, Daniela, it's been, I think, 8 or 9 years since we last spoke formally.
Incredible. That's why I always say there's a lot of downs to social media, but one of the benefits is you get to reconnect with people who, perhaps you wouldn't have found otherwise. So good to be back with you, Puru, and excited to get your thoughts because ever since I've known you, you've been a contrarian and always providing different points of view. So let's talk about your latest thesis and thoughts on why you think we're headed for deflation, not inflation.
Well, I don't think we're headed for deflation. I just don't think that we're going to see sky-high inflation like a lot of people have been forecasting. When the Fed first started QE in 2008 in response to the banking crisis, a lot of people, including myself, thought that QE would actually result in very high inflation or hyperinflation even. But that didn't happen. 10 years went by, and then we didn't really have any inflationary problem, at least when measured by the CPI by the Fed. And then we had all these inflation assets, inflation hedges, which basically performed awfully over that 10-year period. And I fortunately learned my lesson fairly quickly in 2011, late in October, November, when I realized that commodity has peaked, gold and silver had peaked. I even put out a bearish article back then, and I got a bit of sort of hate from a lot of big gold bugs and silver bugs who called me crazy for saying that he's saying commodities have peaked. No, commodities are going to keep going higher because we've got inflation and hyperinflation. But inflation and hyperinflation did not take place back then is because, all the money which the Fed effectively printed basically accumulated as excess reserves within the banking system. It wasn't actually loaned out in the economy because people were already heavily choking in debt. So if you look at what's happening now, the Fed has also started, expanding its balance sheet at a very aggressive pace in response to COVID. And the ECB, the BOJ, all the major central banks are doing the same. The problem is that the debt levels are so high already at the government level, at the state or municipality level, at the corporations level, and also at the household level, that people don't have the appetite to take on more and more debt. And when you have a very high debt overhang already in the economy, then you can drop rates to zero. If people are not willing to borrow anymore, you're not going to get a very high inflation problem. I mean, Japan's been dealing with this for 30 years. And most of the developed world is facing the same conundrum in the sense that you've got debt levels already which are so high. You can give money away for free. If somebody already owes a lot of money, they're not going to borrow anymore. And that is, again, not the recipe for high inflation. That's why I think you are going to see a transitory pickup in inflation because of the stimulus which has been unleashed. And now Mr. Biden has also passed a massive stimulus bill. So we are going to see, I think, a transitory pickup in inflation. But once the stimulus fades, then we're going to see, again, lower rates and central banks struggling to get inflation going because of the debt overhang, which is massive.
And offline, we were saying, Puru, that perhaps there is confusion when we speak about inflation because people will come back and say, how could you say there isn't? Because when I purchase goods and services that I need for everyday life, there's absolutely an increase in these prices.
Oh, yes. I mean, prices are going up. Nobody's saying there is no inflation. All I'm saying is that we're not going to see, in my view, a 70s style inflation nightmare where you have very high inflation. Of course, you've got money printing going on all over the world. Central banks are engaged in buying assets. They are creating trillions and trillions of currency units digitally these days. They don't even have to print it anymore. And that is also, obviously that is being done to try and get some sort of inflation because with the debt level so high, central banks are desperate to try and get some sort of inflation going because if they don't inflate, there's going to be a deflationary bust, which is not good for anybody. So they're going to try their best to try and keep the system afloat by putting band-aids on the patient. And I think you have two sides of the coin, on one hand, you've got a finite amount of resources, like commodities and stuff, and things which people buy, milk, bread, eggs, meat, and all that kind of stuff. And obviously, those prices are gradually going higher over time because of monetary debasement. But also on the other side, Daniela, you've got this huge shift and innovation going on in technology. I mean, the internet is very, very deflationary. Most people don't realize that. Globalization is very, very deflationary, because with the internet now, things cost a lot less than they used to. A lot of the services which people used to, pay for before are now free or very, very subsidized. You want to go to watch films, you can go to YouTube. You want to listen to music, you can go to YouTube. You want a map, you don't have to buy a map anymore. Encyclopedia, you don't have to buy anymore. It's all on Google. So there is a lot of information freely available now, and that is actually saving people a lot of money. And inflation and technology, by its very sort of definition or nature, is very, very deflationary. So you've got, this massive wave of innovation going on in the technology world. You have got globalization, which is also very deflationary, because companies are now able to utilize labor in the poor countries, in the developing countries, at a fraction of the cost of the wages in the West and in the developed world, and that is deflationary. And then obviously you have this huge overhang of debt all over the world. That is also extremely deflationary.
Given the landscape then, Peru, and since you are investing for yourself, what sectors do you like?
Well, I've been invested for the last 6 or maybe 7 or 8 years now in productive assets, mainly stocks. And I'm invested in the high growth companies, because I figured out that, if interest rates are likely to stay low, for a period of time, which I think is likely to be the case, then the growth companies, which are basically long duration assets, which derive the bulk of their cash flows from the future years, many years out, they are extremely sensitive to changes in the interest rates. So if interest rates again head back down again, then I think these growth stocks are going to do incredibly well. And there are a lot of companies which are operating on the cutting edge of technology in e-commerce, payments, software, streaming, video games, and so forth. EVs, the new energy stuff. I think these things are going to probably provide pretty decent returns going forward, even though they've had a huge run over the last year or so, and the valuations are no longer cheap. I still think that they're going to do pretty well over the next few years, simply because the growth rates of the underlying businesses are likely to remain very strong.
You mentioned at the start, yes, you received quite a bunch of hate mail on your views on gold in the past. So I need to ask, how does gold live for you in this environment?
Well, I think if you are looking for a diversified portfolio, and if you are worried about inflation, there's no harm in allocating maybe 5% of your portfolio to gold, as a physical gold, as a hedge against things going awfully wrong in the world. But personally, I've only invest in productive assets now, in companies and so forth, because I find it easier to value these companies based on their revenues, cash flows, and also profits and so forth, or lack of in some of the cases. But it's very difficult to put a figure or value on the price of gold, because it really depends on what the other person is willing to pay for it based on sentiment.
If there is going to be a red hot economy on the horizon, then what do you think about investing in silver, copper, lumber?
Well, I think commodities are going to do well. They have done well because they are inversely correlated to the US dollar. The dollar has weakened quite a lot since March 2020 in response to the Fed's QE initiative. But I think with the debt so high in most parts of the world, especially in the developed world, I see maybe a transitory pickup in economic activity because of the stimulus being unleashed. But I don't think this is going to be lasting. I personally don't think that we're going to go back, especially in the developed world, to an era of very high GDP growth for a sustainable period of time, because of the demographics, because of the high level of debt.
I need to ask you about Bitcoin. You've been very vocal about Bitcoin on Twitter, not afraid to take on Bitcoin aficionados. You don't like it?
No, I don't. I don't like it. And I'll tell you why.
Yeah, I want to know. I know why, but I want the people to know why you don't.
I mean, I understand the allure for Bitcoin and crypto, and I know a lot of your listeners and viewers are going to say, oh, he's salty. Well, I'm not salty because my investment portfolio has done reasonably well over the last several years. So I'm not salty by any shape or form. All I'm saying is that the Bitcoin bugs basically tout Bitcoin as a safe haven asset. They tell you that, no matter what happens, this is your go-to asset in times of turmoil.
Yep.
This is incorrect, because if you see, the correlation between Bitcoin and stocks, for example, if you note, whenever the S&P does well, Bitcoin has done well. Whenever the S&P has a wobble, Bitcoin goes down even harder. So in my view, and if you look at the facts and the history of the price action of Bitcoin and crypto, you will realize that this is nothing more than a super high beta play on global liquidity and on sentiment. So when risk assets are rallying, crypto does well. When risk assets are not doing so well, crypto falls extremely hard. And if you see the last cycle, in the last cycle, crypto, I think, peaked in December 2017, perhaps, if I recall correctly. And that was just before the Fed started reducing the size of its balance sheet. So crypto is extremely sensitive to the monetary changes, and it is a high risk, high beta, high volatility play on the global liquidity. It's not a safe haven asset. It's not a store of value. It is simply a play on global liquidity and a super high beta play at that.
Okay, if it's a speculative play though, as an investor, right?
Mm-hmm.
Why wouldn't you just go in for a bit, make a lot of money like many people have, and get out?
Because I'm not smart enough to know when the price of Bitcoin is going to peak and how much it's going to fall. If the short history of Bitcoin is any guide, it has fallen 70-80% on more than one occasion. And it may go up to 100,000 or 150,000 or even 200,000.
Right.
I really don't know. But at the same time, I do know that when the monetary music slows down or stops, it's going to have a vicious crash. 60, 70, 80% wouldn't surprise me, and I just don't want to be holding the bag.
So when proponents of the crypto argue that Bitcoin is the future, that it solves all problems, that it is the ultimate wealth preservation, what's your response to that?
What problem does it solve? Can anybody explain?
All problems. You haven't taken the orange pill, Puru, that's why.
Name me one problem which it solves.
If I have to send money to you right now in Hong Kong, look how easy it is with Bitcoin.
It's very easy for me to send money to you in euros and dollars too. All I need to go is log on to my online banking account and transfer yen, euro, dollar, whatever I want, whoever I want, and you'll get it within a day. So why do we need Bitcoin? And if you look at the transactions, Visa processes tens of thousands of transactions every second or whatever. And how much does Bitcoin do? It cannot scale. The proponents of Bitcoin keep saying that, this is the future of money. But the problem is you cannot have widespread transactions on Bitcoin at the moment. Maybe it will change in the future. But the way things stand today, in my view anyway, and I could be wrong, it is just a speculation on global liquidity. I'm not saying if you want to play it, play it, but just know that you are basically speculating in an extremely volatile beast. And, if you are going to put in 20, 30, 40% of your portfolio in it, just be mentally prepared that one day it may go down 60, 70, 80% before you know it.
Last point on Bitcoin, Michael Saylor moving MicroStrategy into Bitcoin. We saw Elon Musk play. Do you think that we'll see other CEOs take a cue from that? They're saying
possibly. Possibly. Humans are social creatures and they tend to move in herds. So it wouldn't surprise me, if more and more companies start buying crypto. Right. I don't necessarily think it's a wise idea or a wise move. Certainly not with 100% of somebody's balance sheet. If it was me as an investor in MicroStrategy, I'd pull my money out straight away, because the MicroStrategy is no longer a business. It's effectively, is a casino of Bitcoin. If Bitcoin crashes 80, 90% or 70%, MicroStrategy stock's going to go down with it. So I don't think it's a very prudent way of managing, a treasury of a company, let alone someone's entire portfolio. I think if you are going to speculate, put a smaller percentage if you want to play the game, and just be mindful that it can go down a lot.
You mentioned Bitcoin's not a safe haven for you. Is gold a safe haven?
Gold historically has been a safe haven over a very long period of time, against monetary debasement. And if your time horizon is 20, 30, 40 years,
right.
Yes, I think, no harm in allocating some to gold, because I think if you look at the various asset classes, I think gold is going to do better than cash, because cash has lost most of its value because of monetary inflation. The dollar has lost over 95% of its value because of money printing for the last 90 odd years. So I think going forwards, the paper money or the fiat is going to continue to lose its value over time because of money printing and debasement. So I think gold is going to basically keep its value in real terms. Do I think it's going to be the best performing asset over the next 10, 20, 30 years? I don't think so. I think stocks are going to do better than gold.
But for wealth preservation for yourself, Puru, if you're allocating a portion of your wealth for your children down the line, down the future, where do you put it?
I mean, I would own businesses. I would own maybe property. I would own farmland, productive assets. I know gold is an inflation hedge, but so is real estate. So is farmland. There are plenty of ways to skin the cat, as they say. So, you don't have to own lumps of metal. If you want physical assets, you can own real estate. Real estate is a physical asset. You have titleship over the land and also the structure. You can collect rent from it. If you basically stick a tenant in there, you can collect passive income. You get paid for waiting. So if you want to invest in gold, I think there's no harm in allocating a small percentage of your portfolio to gold or indeed silver. But I don't think this is the be all and end all asset class in the world. There are many ways where one can hedge the inflation exposure or concern or fear.
Puru Saxena, I appreciate you coming on StansberryInvestor.com. I thoroughly enjoyed this conversation today, and I hope we don't wait another 9 years.
Thank you very much, Daniela. My pleasure.
And thank you so much for watching StansberryInvestor.com. We'll have much more for you, so be sure to stay tuned. In the meantime, share us where you watch us. Thank you for watching. I'm Daniela Cambone.